Good morning. It's December 10th, Friday, 6:34 a.m. Welcome to episode 26. Good morning to you, Wawi.
Good morning, Mark. How are
Uh,
you?
good. And good morning to our listeners. Finally, it's another week. Another week has gone by. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Markio and Wawi show. I hope you guys had a great week so far. Just a disclosure, this show is made for sharing purposes only and not to be considered investment advice. Me and Wawi record once a week. We are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. We are available in YouTube, Spotify, and Google Podcasts. On our previous episode, for you guys who have missed it, we discussed the Fed's decision to forego the word transitory, the ongoing decline in consumer sentiment, weak Thanksgiving weekend retail vibes, the recovering job market, sentiments. We go about it every week, and the money flows in the stock market. We also reviewed the SPAC, IPOs, the work from homes, the meme stocks, and their boom and bust so far this year. And we also have a couple of roll the clip segments, which were bullish takes from JP Morgan and Fundstrat. So for this episode 26, Calm Before the Storm. So we came out with the lowest jobless rate yesterday in the last 52 years. Good news, right, Maui?
Yeah, it's good news, but the employment is still not normal.
Mm-hmm.
We haven't reached normal levels yet on employment.
Right. I think we are still off from all-time highs back then before the COVID strike. But so far, this is a really good sign, I guess. It might take new claims. It says here, new claims for unemployment insurance dropped to 184,000, the lowest level in 52 years. According to an expert, it says here, quote unquote, seasonal adjustment factors continue to wreak havoc with the data, and the claims figures may remain volatile through the holiday season. Looking past the noise, we think claims will eventually hover more consistent around pre-pandemic levels of 220,000, assuming the Omicron variant of the coronavirus has only a moderate negative impact on the economy, according to Nancy Vanden Houten and Greg Dacko of Oxford Economics. I think in my case, while we were waiting for that new normal, or at least back to normal pre-pandemic levels, I think this kind of indicates that the job growth here in the U.S. is growing strong, nice and steady. And
Yes.
we actually, me and Wai, we kind of thought about it a couple of episodes ago that this might be an indicator that peak or top job levels are coming soon, or this will be like the strongest comeback. I mean, if people are still in the mode of like resigning and looking for a better offer somewhere else, would this be the peak jobs uh, era or point of time?
Well, it could be, Mark. The forecast
Mhm.
stipulates that by this quarter we should reach 59% on our employment rate, and
Uh-huh.
by next year it should reach 60%,
Uh-huh.
and maybe level off to 61% by 2023,
Oh,
according
okay.
to Trading Economics.
Oh, that's good. So previously, pre-pandemic, we were hovering at the same levels, right? Around 60s.
Yes, yes.
Right. So we're almost there. We're almost there. That's important to know because Federal Chairman Jerome Powell is looking closely at this peak employment, and
Mhm.
that would indicate one of his goals before setting the rate hikes. So rate hikes, everybody is not like a deterrent, but it kind of like suppresses the flow, the ease of money flowing from savers or flowing from bonds to more risky assets, which is AKA equities or stocks. So that could hamper down or tame down the wild bullish outlooks in the stock market. So going on to our next. So Peter Lynch, has making some waves recently, because I think primarily he's donating most of his paintings to a school, him and his wife. And as well, he prevented the commentary that being invested in the passive investing is kind of like being you, as a result of passive investing, you are more prone to missing out on some returns. So this is an article from Business Insider entitled "Legendary Stock Picker Peter Lynch Warns Against Passive Investing After the Big Short Investor Michael Burry Called It a Dangerous Bubble." So Peter Lynch, during an interview in Bloomberg, said that, quote unquote, "this move to passive is a mistake. Quote unquote, people are missing the boat." He added, noting that he expects the best active managers to consistently trounce the market. There is, quote unquote, there is all this opportunity, but so few active managers looking to take advantage. So for those guys who are not familiar with Peter Lynch, he established the Magellan fund back in the 80s to 90s. He's one of the best best fund managers of his time. He actually retired on his peak after showing, like here in the Market Insider article, after posting 29% annualized return over 13 years while managing Fidelity's Magellan fund. So this guy is a really like exemplary in terms of his performance as a fund manager, bringing his clients 29% return. If you had put 10,000 in his fund since he started his Magellan fund, you'll be reaping a lot of benefits, like 29,000 in the first year, and it snowballs. In over a decade, he's been returning 29% per year. So assets from his Magellan fund, according to this article, grew from $18 million, million with an M, to $14 billion in the span that he was a fund manager. So quite an exemplary fund
Yeah,
manager
that's
right here. Mhm.
definitely extraordinary for Peter Lynch at those days when you're having to evaluate a company
Right.
quite deeply, financial statements and stuff like that. Um, I don't know. Has the game changed, Mark? Is it still value, you know,
Value
based,
oriented.
value oriented investment, or we're just gonna game it? What do you think?
Not totally sure. There's corners of the market that are highly speculative, and there are corners that are kind of like, nice and steady flowing as long as you put your money in, which kind of like goes to the track of being passive investor actually. So
Mm-hmm.
him saying this, I mean, given his background, he has probably this kind of like, biases, but it's also tough to find a good fund manager nowadays. I mean, for one, I think back in 2014, 2015 was Baby Buffett or Bill Ackman who's like making the noise as the best fund manager during that time. I think it was
Mm-hmm.
2016 even. And not so recently, it's ARK Invest, Kathy Bay,
Mm-hmm.
who's been like outperforming the market for the last 5 years.
Mm-hmm.
But not so recently. So far this year, it's been which we're gonna take a closer look into, like her fund's performance.
Mm-hmm.
So it's kind of difficult because, I mean, for all we know, these fund managers they already receive fee performance or fees, actually management fees annually on a set basis on a percentage of the whole fund that they're whole fund assets that they're investing in.
Mm-hmm.
So, I mean, it could be that they still aim definitely to be an alpha, or alpha meaning beating the overall stock market. But nowadays, it's kind of like interesting to go about, selecting the best fund managers. As I typed here in Google, who are the best fund managers? And we have here like the best fund managers of all time. And it's not even a fund. Warren Buffett, as we know, owns a company. It's Berkshire Hathaway. So in this aspect, he pulls the cash from all of his businesses and invests it in the stock market, or he buys out businesses like Precision Castparts back in 2016 for 16 billion. Um, George Soros, Ray Dalio, Seth Klarman, David Tepper. Like if you want to invest in their funds, you have to meet a certain criteria. I think they opt for clients that are accredited or accredited investors. Those people who have met those criteria before they accept those funds, and there are limits like 100 to 150,000. So quite not sure of that advice, but some of the best fund managers of Peter Lynch, like Peter Lynch, but certainly good to take note of. And as I was thinking about that, I was able to pull up this account, this article that was just published sometime this week, per Bloomberg, quote unquote, the title: "Retail traders trail professional stock pickers by most ever." So Peter Lynch has some point here. I'm not sure if he's referring to this article or he's just come up with it during an interview, but as it said, now data's or evidence are showing that retail traders like you and me, those who don't have licenses or who don't do this on a professional or daily basis, we don't clock in and clock out being paid to trade, um, you know, are trailing the professional stock pickers or hedge fund managers. So Byline says stocks favored by mom and pop continue to underperform. Losses in Tesla, Beyond Meat contributed to Gage's rout. So individual investors who reap eye-popping returns that made some pros chuckle earlier this year are facing a moment of reckoning. Obsession and risk on assets, YOLO, you only live once, was a blessing for amateur traders. This kind of reminds me of those meme stocks while we had the GameStop and AMC's earlier in this year.
Yes,
So,
and it's still going, right? A lot of retail investors have bought into GameStop again
oh, really?
yesterday after seeing a dip. They're still buying the dip.
Wow, the buy the dip momentum or attitude. We if we recall, right? While last week we were just looking at some of the meme stocks. It
Hmm.
definitely has underperformed since that spike back in February. So that quite interesting turn recently, and now evidence are showing. Excuse me. It says here, retail investor stock picks trail mutual funds favorites by most ever. So this is not just from year to date. This chart from Bloomberg goes all the way back, well, to 2018. But it says here
Hmm.
by most ever. So probably they kind of look into farther history. So far this year, it's not been good for sticking with the most crowded trade for mom and pops. So it says here, individual investors incurred several big losses last week, from Plug Power, plunged 17%, Beyond Meat 16%, Tesla 6%. There must be an quote unquote, there must be an issue with either meme stocks losing interest, that's number one, or number two, general profit taking into the year end, according to Ben Emmons, global macro strategist, Medley Global Advisors. Hmm. Makes sense, right, Maui?
Yeah, it makes sense. There are still popular stocks. Tesla, Apple.
Oh
There's
yeah.
still yeah. Apple is going up, by the
Uh-huh.
way, but their popularity is still there. But I think people are expecting some rotation, so they're getting back into some value. What they call value stocks.
Right. And yeah, and that kind of reminds me of the rotation. So since first quarter of this year, the bubble popped in some of the meme stocks as well. And I think if some people are being advised to take their tax losses, they might be ending up, selling these stocks, which results into less demand for the stocks, ergo, lower price action. So now we're gonna jump into this week's episode. Gonna change it a little bit. We're gonna play some roll the clips from none other than ARK Invest Kathy Wood. So she had quite a busy week so far. She's been receiving interviews from Bloomberg, CNBC, but here we have at least 3 videos of her recent interviews just to gauge like what is her mentality or her mindset at this point in time now that her fund is really slumping compared to the overall index.
Hmm.
Let's roll the clip.
It'll be interesting.
Talk about Tesla or Twitter or some of your other holdings. Can you opine quickly on what do you think about Tesla and where it is right now? Elon Musk's recent comments about the build back better, build back better, build a lot of these. But can you comment on that and Twitter? I know you recently.
I tend to agree with Elon Musk. I think more people understand now that the electric age is here. And so Tesla is being rewarded accordingly. It has the highest market share out there. And it has, even now, 4 barriers to entry that other companies are having difficulty overcoming, especially when it comes to battery technology and artificial intelligence, which will lead to autonomous. And that's now where Tesla is undervalued. You have to assume that the autonomous strategy is going to work. We assume in our $3,000 forecast that there's a 50% chance that its autonomous strategy is going to play out. And our confidence is beginning to increase now that the pilot test is taking place, and you've got devoted Tesla owners really identifying the corner cases that are causing problems for full self-driving. So we're pretty excited about that. Even its electric strategy should take the stock much higher than it is right now, but we are gratified to see that others are beginning to understand this story, and that Tesla is acting a little more FANG-like than it ever has.
How about Twitter? That you got to buy that, and this I guess not watch it every day. Probably there's a lot of headwind.
Well, we love, so the new CEO, we think, had been working with Jack closely on some of the new monetization strategies. We think tipping will be one of those. But there is a sleeper in Twitter that we think most people don't understand. We've moved into an age of NFTs, non-fungible tokens, and they will need a verification platform. NFTs are all about scarcity, and verification is testimony to scarcity. So I think Twitter might play a bigger role in that realm. And then, well, the main reason we own it, this we use it prolifically, as you do as well, Joe. And what we're seeing is that this platform, which used to be dominated by tweens, teens, and celebrities in 2012, when we first evolved our research ecosystem, has now evolved to knowledge workers. And we find it essential at ARK to engage with the communities we are researching, and actually to become a part of those communities. This is a very powerful social network. And if you're talking about knowledge workers, you're talking about one of the premier demographic profiles out there. So we think from an advertising point of view, you've seen advertising turn around on Twitter. We think that's going to continue. And we think more and more users will understand how essential this tool is to knowledge workers.
We all want to be transparent, I guess. I don't know. Sometimes I don't feel like being that.
Well, I think she's definitely bullish in both Twitter and Tesla. Ever so bullish.
Yeah, well, again, this is the ecosystem. Who's gonna provide charging? You know, will there be a universal charging stations for all these EVs that may come up in the future?
Right.
Is still, well, Tesla most likely is not gonna monopolize that. So we have Blink charging, we have ChargePoint that are trying to corner the market right now. But yeah, the problem is if it gets commoditized, they may lose some of their power. But speaking of Tesla, well, one of his projects is Starlink, right? Did you hear about the news that Russia just exploded a satellite, one of their large satellites that are no longer working?
Oh,
now a lot of now it has like 1,500 pieces of trackable pieces flying through space, and now the International Space Station can't do their spacewalks. And then some of the Starlink satellites had to be brought down lower, I believe, lower orbit, so it won't be damaged by these particles that are floating in space.
That's dangerous.
Yeah, so speaking of ecosystem, we have all of these links that Tesla is going to do, a network, larger than the GPS network that the United States have. They have, I don't know how many satellites up there, but it's like more than 1,000 now from Starlink. So they will provide a highly sophisticated GPS network, more than what we have currently. I think we have 26 GPS satellites or something like that,
right,
to geolocate our positions.
And I think SpaceLink is the one that's leading among all of other companies compared to even governments that has like numerous satellites out there.
Yeah, so that's another ecosystem that Tesla is well, it's not part of Tesla, but they can use that.
Right. If he decides to list SpaceX, I think that will eventually bring his net worth
oh
to
my gosh,
more than $500 billion.
I would say so. That's a big market too, space.
Yeah,
But there's a lot of risk.
Definitely. I'm looking at some Twitter information here, and looks like, well, it's been growing its revenue, 3 billion in 2018, 3.5 billion in 2019, 3.7 billion in 2020, even with the pandemic. And it looks like even though it's growing its revenue, its profits has been nice and steady, except for 2020, which is understandable because of the pandemic. But its profit was 1.2 billion 2018, 1.47 billion in 2019, and a loss of 1.1 billion in 2020. So I don't know. I guess definitely marketing or advertising business of Twitter is improving, but profits have yet to show, especially coming from pandemic last year. All right, let's roll the clip. On the next segment, it's still Kathy Bay. This time she's up on the stage. This happened a couple of days ago, December 6th. Fear of inflation is scaring markets, says her.
Part of what's going on is tax loss selling. That's just a technical factor. Beyond that, I think that the fear of inflation and interest rates rising, especially after Chairman Powell declared that perhaps inflation is not transitory here, has scared the financial markets. This really started in mid-February, this correction. So this is a very long correction for us. We actually think the bigger risk is deflation by far. I disagree with Barry completely on this. And I look at these rent increases as major tax increases effectively on the lower income earners, and the same thing with gasoline prices. The University of Michigan Consumer Sentiment Index is lower now than it was at the depths of the coronavirus. Why? Because purchasing power is diminishing here so much. I also think that businesses that have spent the last year and a half scrambling to catch up with consumption, they were way behind, are now overdoing it. And we are in the middle of a major inventory build that is going to unwind next year. So that will be a cyclical deflation. And then innovation itself is inherently deflationary. We're seeing, just to give one example, artificial intelligence training costs dropping 60% per year, right? And AI is going to permeate every sector, every industry, every company. It's going to become, very competitive. So we think, and that's just symptomatic. There are so many other deflationary forces out there associated with DNA sequencing, robotics, energy storage, blockchain technology. So, and what we're also seeing is the convergence between and among these various innovation platforms, so that one S curve is going to feed another and another. And so people are saying, well, then why are these stocks going down? The question we used to get is, we're in a bubble, aren't we? I said, we're not in a bubble. And now that our stocks are down, but the averages are, many people are thinking we're in a bubble still. And we are. And it's called benchmark stocks, which are going to be disrupted as the traditional world order is disintermediated and in often cases is going to be destroyed by this new world. So you can say I'm talking my book, but those are two massive secular deflationary forces. One is extremely positive. Deflation, learning curves, cost declines, price declines in innovation means we'll get a boom in innovation. The other side of that is there are many companies who, especially since the tech and telecom bust, and then again, 08, 09, they've catered to short-term oriented shareholders who are scared. They've been scared ever since 08, 09, and they want their profits now, they want their dividends now. So these companies leveraged up, buy back shares, manufacture earnings, and didn't invest enough in innovation. They're going to face a lot of problems, and they will face the bad kind of deflation.
Wow. So she's saying that it's the benchmark that would eventually give out or eventually be in some cases destroyed if they're not investing in innovation. What a strong use of words there, Bobby. What do you think?
Well, if she's right, then what's the new benchmark, right?
Yeah, I know.
So those new benchmarks probably would be Amazon, for one. These type of companies that would use their cloud services, Microsoft. But like you said, we will be permeated by all this technology in the future, and you can already see that, right? The popularity of Spotify, the integration of blockchain technology into our credit card companies. Mastercard is building its own ecosystem right now where they can integrate crypto wallets and NFTs. Visa is doing the same thing.
I mean, it's for these benchmark. I'm quite astounded by what she had said. Like, it's a threat for the benchmark because, for one, she's saying that we're not in a bubble. Probably we're no longer in a bubble because her, in terms of referring to her index as a bubble, if it was in ever such shape, it's now down quite a good amount. So I think that's what she was referring to, that we're no longer in a bubble or we're not in a bubble. But the benchmark, she's saying that it could either, be an underperformer or still in a bubble. They are the ones who's going to be suffering if they don't invest in their research. So I'm just looking at Apple here in terms of its research and development investments or operating expenses. They've been investing quite a good amount. Since 2019, they spent 16 billion. 18.7 billion in 2020, and so far this year 22 billion already. This is a fiscal year, so they end their fiscal year in September. So I think for 2021 they already invested 22 billion. So these companies, I'm pretty sure they're quite aware of what's going on.
Yes.
Just think of it, Google, it probably already knows more about us or than ourselves, because we usually use their Google search bar. So these companies are not going anywhere, in my opinion, but
No.
there are other companies that might actually suffer because of non-investment or lack of investment in R&D.
And integrating AI, VR is gonna be a new force to contend with.
Right.
I think in the next 2 or 3 years. Apple, with its R&D, has not released any of their high-tech products as of this time.
True.
I firmly believe that they're just waiting for the market to come along before they release their new products.
Yeah.
It's so way ahead of time that they're just making sure that the market is gonna buy it.
Right.
So they
And
haven't released it.
that's a really good observation there, Wawi. Because what I'm now thinking, as you've said those words, is I think Apple is getting more and more into like what the consumer would buy. In terms of like, for example, they have the phone, right? So they have the phone. People are using it
Mhm.
with their hands. They bought ever since Steve Jobs passed away. I think they bought Beats, which is headset where I'm currently wearing for my ears,
Mhm.
and then now they're looking at the AirPods still for the ears, I guess,
Mhm.
and then now they're trying to gauge or make venture in the electric vehicle, which is kind of like decades away, and I've seen like their focus is probably trying to get more consumer products that are Apple branded instead
Yeah.
of like pursuing like more and more aggressive innovation compared to like, let's just say, Samsung. Well, Samsung is still hooked into its foldable smartphone, but I guess
Mhm.
Apple is getting more trying to tailor itself as a number one consumer high-end product or some sort.
Well, changes are taking place, with
Mhm.
Facebook, announcement of metaverse,
Right.
and so it's laying the groundwork for Apple to start testing their new products. And I know what they're doing. And
Mhm.
one of the things that they're doing is trying to build a VR
VR,
uh,
yes.
headset, eyeglasses that
Mhm.
will. It's already out there anyway. There are some
Right.
glasses that would tell you what this product is or scan a barcode.
Mhm.
Um, it's one of the products that I think would, I don't know, it's already used in the industry,
Mhm.
surgery. The company called Vuzix, Vuzix is already
Uh-huh.
using it in industry, and Apple has their own product for consumers.
The VR
Um,
headset. Oh.
well, eyeglasses for one,
Uh-huh.
and display, which is embedded in the eyeglasses, combined with your AirPods
Oh,
kind
that's
of
pretty cool.
technology.
Mhm.
Uh, but who knows how it's gonna evolve? It may evolve depending on market trends.
Right. May brings into mind what I've just watched over the weekend. The movie is kind of old. It's called Surrogates,
Mhm.
where Bruce Willis stars. Where these people are just of that age. They were just wearing headsets and
Mhm.
they control an alter ego,
Mhm.
which is in the same real life situation, where they're looking more young and more professional, and for some sorts the movie is kind of like trying to solve a murder problem, but for it's like a Real Player One for those who have
Yes.
watched Real Player One, but in a live real world simulation. But yeah, not to go digress too far. So we're
Yes.
going back to the roll the clip segment. This is entitled maybe time for a new market playbook. So this is in terms of like how you would be approaching your investment strategy moving forward. Let's roll the clip.
We try to sort through a really tumultuous week. What really affected the markets and what was just a feint?
Well, I think the combination of the virus and the Fed is sort of the perfect storm, because on one hand, you had the Omicron virus holding back certain parts of the market, such as the reopening trade. And on the other hand, the March 22 COVID playbook was completely crushed by the Fed, because you think about who that was. It was the beneficiaries of cheap money, such as your Pelotons or stay at home. And no other manager really exemplifies that trade as well as Kathy Wood. And if you look at her fund, ARK is down 16% since Thanksgiving Day when we learned of the virus. And typically you would have thought that would have been your go-to playbook. So what this means is you need a new playbook this time. The Fed's change of stance is very material.
So Rebecca, I'm curious about that change of stance from the Fed. is it a change of stance in that we know that they're going to taper and that they're ultimately going to hike, or is it rather let's improve our options?
I think it's the latter, really. The Fed is trying to make sure it has optionality. It's still not sure if inflation is going to be where, quite a bit lower next year or quite a bit higher next year. But by speeding up the taper, you can address inflation expectations, make sure they don't de-anchor now. You finish the taper, and that's completely separate from tightening. So if inflation stays high, and we think the risk is that inflation could stay high, housing supply is going to take a long time to come back. Labor is going to take a while to come back. Energy, commodities, those supplies are going to take a while to come back. So that inflation pressure is going to last. If that's true, then the Fed can raise rates faster. And right now, we only have 2 hikes priced in for the second half of next year. So there is room for more to get priced in, and that can push yields back up just as fast as they came down this week.
Yeah, exactly. A very powerful point. Barbara, and let's talk about that inflation issue. If in fact it stays up, are you starting to see it sort out some of the stocks? You get involved in individual stocks. Are there certain stocks you want to go to in a high inflation world?
Oh, absolutely. I mean, I'm very fond of green metals, for example, and they're a beneficiary of inflation. And I think every portfolio is woefully underallocated to them. But I think, what the market's telling you right now is that the Fed might be doing a deflationary lower growth policy mistake. The markets are expensive, whether it's a stock or a market, David. Punching multiples hate lower growth. And that's what people are afraid of, is that we will have lower growth. And so you'll see multiple contractions. So the stocks that you absolutely want to stay away from are sort of what I would call those, speculative bubble ones, where they have no earnings, they have no, and that game is sort of over. So it's more right now, how do you protect yourself from things that have been beneficiaries of this environment?
Well, let's pick up on that just for a moment, because one interesting thing at the end of the week I saw from Charlie Munger, actually, Warren Buffett's partner, is pointing out how many of the NASDAQ 100 stocks actually are below their 52-day low as opposed to above. And it's sort of a record number. It's like 588 or 3,500 or something like that. Are we seeing something like a bursting of some of the tech bubble?
Well, we try to monitor for bubbles in the stock market, and based on our own calculations, there's probably about 10% of the US stock market that we would consider frothy. But the bulk of it, we think, is fairly valued. And a lot of the stocks that we think are frothy are in that speculative camp, right? We also know from the US that over the last decade or so, we've gotten more US stocks that are very sensitive to liquidity conditions. So picking up on what Barbara was saying, to the degree the Fed is forced to tighten faster than is discounted to address inflation, you do have a section of US stocks that are going to be more vulnerable to that than they would in past cycles. Same time, I'm not seeing any evidence yet that growth is slowing. This is a fear tied to the Fed, a fear tied to Omicron rather than a reality. And we think there's a good chance you're going to have a self-reinforcing cycle next year with inventories rebuilding, CapEx spending, wages going up, helping the consumer. And if that's the case, then there's going to be plenty of stocks that are going to benefit from that probably aren't that overvalued right now.
So Barbara, let's pick up on that just for a moment with the Omicron, because we started the week really pretty concerned about it. That concern seemed to wane during the course of the week. But some people were saying we might end up with the worst of both worlds, which is on the one hand, suppressed growth because of Omicron, if it really comes back strong. At the same time, increased inflation because it may affect, for example, supply chains.
I think that's right. And I think this is where we need to be very clear. There's more than one source of inflation. It's not all monetary, right? Supply chains are a source of inflation, and the virus could exacerbate that due to lockdowns and travel restrictions. If you look at energy, we have an energy crisis in Europe and China. Last month, the PPI in China was up 13.5% on the back of higher energy. The PPI becomes the CPI. And if you think about the cost of energy, that's nature's discount rate, and it impacts every industry. So I think energy is a real source of inflation. Then you look at food prices, they're up 30% year on year, in part because the price of ammonia has gone from $100 a ton to $1,000 a ton in a year. So, and then you look at shipping costs. We all know the price of a container was $2,500 pre-pandemic. It's $25,000 today. And lastly, nearshoring. We've gone from just in time to just in case. McKinsey put out this report and said 92% of their clients had invested in nearshoring to bolster the resiliency of their company. And you just have to look at someone like Ford and GM, who are doing deals with chip suppliers to manufacture domestically. That is inflationary. So if you think about one of the sources of deflation for the last 25 years has been China. And if they are no longer going to be a source of deflation, This is a radically different. This is inflation due to structural issues, and this is something the Fed can't fix. So I think inflation is here to stay for longer. Call me crazy, but it might not be the worst thing in the world because you can inflate your way out of debt. And what COVID did was it took our debt to GDP up to 125%. And it's never been higher than that, not even during World War II. And one way to delever is to inflate your way out of it. So I love that the Fed dropped the word transitory. I'm just waiting for them to say it's necessary.
Well, this is a favorite topic, I think, at BridgeWater. Actually, you inflate your way out of debt by deflating the value of the currency. Is really what that does. It
Right.
discounts the currency. Is that a good way out of this?
Well, if you have to choose between a deflationary depression and modest inflation, both of them have costs and benefits, but the cost of inflating your way out is going to be spread a lot more evenly across different cohorts than a deflationary depression. So if I had to pick one, I would completely agree. Setting inflation at a higher level is probably going to be a much less painful way to deal with our debt.
Let me ask you one last question here before we go to the break. And that is, you mentioned liquidity. The cost of capital for a lot of companies has been approaching zero for a long time. Has that really saved a lot of companies or promoted companies that otherwise would have to make some tough decisions?
Yeah, I think that, look, it's important to remember tapering is not tightening, right? So if we're tapering, we're still adding liquidity to the system, just at a slower rate. So liquidity conditions are starting to normalize, but we're not tightening that quickly yet. That could change next year if inflation stays high. And I'm sympathetic to the points Barbara was making. But I do think that what COVID did is it released this coordinated fiscal and monetary stimulus, the biggest stimulus we've seen outside of wartime in modern history. And it's meant that balance sheets for companies and households are much, much stronger. And so, yes, there is some risk as liquidity conditions tighten and cost of capital goes up. But the starting point for companies and households is extremely strong right now. So that could help prolong this cycle for longer.
Phew. That was really packed right there, Wowie.
Mm-hmm.
Looks
A
like
lot.
uh-huh.
Yeah, a lot of information, but she's right. With our M1, M2 money that people have, a lot of their savings still in place.
Right.
We're still in a good position.
And
But
oh, go ahead, sir.
out of all this noise about Omicron and inflation, right? We already know there's inflation. It's like 6.7%.
Highest in
As
33 years.
So it's there, and they're gonna taper. I don't know at what rate. Maybe slowly is what everyone is thinking about. But if you're an investor, okay, always think about how competitive is your investment, right? If you're investing in a company, pick the companies that are very competitive. What's their competitive advantage?
Right. The companies who can actually raise their prices when inflation starts abound. That way they could be more, profitable, or at least maintain their profitability. Like what we looked at a chart last week, profitability margin for all U.S. companies, even with their warnings back in June, are still climbing up. So these companies are able to withstand the largest spike in inflation in the last 3 decades. And the thing that caught my attention on this interview with these two really good investors, because for one, I think the one Rebecca Peterson, she's chief investment officer of BridgeWater Associates. For those investors who are not aware, BridgeWater is a hedge fund that was founded by Ray Dalio. So it's the largest hedge fund in the world. So she's saying that she is in agreement with the other investment officer, CEO of Wincrest Capital, Barbara Bernard, that inflation might actually be good for investors because we're going to be able to inflate our way out of debt. So it's and the guy who's interviewing is really kind of like a financial expert, but he used the words currency and all that, which kind of like might get some people confused. But in layman's term, just think of it as, like, for example, having the money. Let's say you have $100,000, you don't use it, you just put it in the savings. So inflation is gonna eat a lot of that while you sleep for at least a year. So if you kept your money 100,000 in savings, inflation at 6%, by the end of the year, it's already 94,000 because inflation already ate 6% of that. But if you invested that money, and let's just say in a $100,000 house, and that value of the house increased because it inflated 6%, so you just paid 100,000, but by the end of the year, it's now 106,000. So you kind of like inflated your way into that asset, gaining some equity value instead of losing it. I think that's that's my
Yeah.
interpretation of inflating your way out of debt. You're getting into a good debt in this time because you're investing that hard-earned money. So I
Yes,
guess so.
I
It's
agree,
good.
Mark.
Yeah, I think it's overall good for the economy, which we're gonna see in a little bit that the household wealth has actually increased by most in a recent time period. So this is the one more video. This is usually these videos we save it. The roll the clip segment we save it for the latter end. But on this episode, we're trying to get ahead of it. So we're gonna play this Tom Lee interview by CNBC, which is for those who are closely following our episodes. This guy has been always bullish, 120%. So let's play this. It's been it happened at least 4 days ago with CNBC, 67,000 views. Titled "Why Tom Lee Still Expects a Rally for the S&P 500." All right, let's play.
Tom, we've talked about year-end melt-up. Now we're hearing more about mid-December in terms of seasonality, getting some last-minute strength. But you do acknowledge that your target is now a tougher call.
Yes. Good morning, Carl. It absolutely is. The S&P lost 200 points in the last 10 days. It's down 5%. So from 4,500 to 4,800 is a huge move, and it's a big ask. But I think given how much cash has been raised on the sidelines because of investor panic around the Fed and Omicron, I think it's still in place. So I would say our base case is still we exit 2021 above S&P 500, 4,800.
Interesting. Do you think you need to have things like the VIX go back to somewhere in the low 20s before people sense an all clear? Or do you think bets are going to get made in advance of that?
That's a great question. We highlighted in our note this morning that, like when you look at prime brokerage data and investor gross leverage is at the lowest levels all year. And if you look at money market funds, institutional investors raised cash 5, 6 consecutive weeks, the highest cash balance all of 2021. And so it looks like people panicked because of the Fed's pivot and Omicron. And the VIX is another way people bought protection. So, Carl, I mean, the reality is like the VIX could easily make it a move back into the mid-teens in a matter of weeks. That, I think, would be coincident with the rally starting. And I think, for instance, again, I'm not a scientist, but all the incoming anecdotes haven't shown Omicron to be more lethal. And the Fed's already made what looks like a hawkish pivot, and that's been almost immediately priced into credit. So, as you know, if things get less bad, that's good. So I kind of just still think what's in play in the next, between now and year end is actually a strong rally. It's just, of course, from a much lower level.
Tom, what do you make of investor sentiment overall here? And 3 things I would call out: the strong moves higher on Snowflake and Okta last week after earnings, or they're still lower, say, for the month. This rally that we're seeing today in names like IBM and Apple, and then NVIDIA and AMD, which have performed so well throughout the year, are lower by about 5%.
Yeah, John, part of the tech headwinds this year has been that they were just so good in 2020. And so many stocks got earnings growth and, strengthened their market position, even had pricing power, but then their PEs derated. I think that reverses in 2022. So to me, like big cap tech, the FANG complex, a lot of these high quality, large cap tech, especially leaders, I think are going to be the things people allocate to in 2022. And keep in mind, the 10-year now is at 1.3 something. They talk about TINA. You're paying, almost 70 times for 30-year bond, a 10-year bond actually. And so I think equities with its sub 20 PE is just still a great risk reward.
Wow.
Still
So-
bullish.
Right.
I think I might get my Santa rally or post Christmas rally.
Right. Oh yeah.
We'll see.
Yeah, we made this poll in our little group in Messenger, and there were only a couple people who it's you and one more person, right, Wawi?
Me and
Who-
Tom Lee.
Me and Tom Lee. Oh, on the group that voted for if there's still going to
Yes.
be a Santa rally, and most people, most members voted no, including me. So that was during the depths of a sell-off since last week. But I
Mhm.
guess yeah, Tom Lee has some good info right here. Like on the last few seconds, he said that if you're gonna be investing in bonds, you're actually gonna be paying 70 times its value. That's how much overvalued bonds are. And stocks at this point are 20 times earnings, or about 22, 23 times forward earnings, compared to back in June. I think it was around 27, 28 times earnings during the all-time, like we were just recording all-time highs day after day. So if that's the case, then probably there's some more pull ahead, some more spikes coming up pretty soon, and maybe you'll get the Santa rally, Huawei.
Yes. So shout out to Dylan Semanes.
Oh
We're
yeah,
the two that's voting for a Santa rally.
right.
Yes.
It's you and Dylan. Yeah, that's interesting. So we'll see. We still have how many days? 2 more weeks to go. Wow.
Mhm.
2021 almost in the yearbook. And it's another year. So
Mhm.
here's an article from Seeking Alpha published yesterday. Kathy Wood, innovation stocks could quadruple in 5 years. I guess she's always bringing it up that she has a 5-year horizon. And she says that she's seeing annual rates of return for her investments by about 40%. So added that she said that Tesla and Twitter. Well, we just played her segment a couple minutes ago. She said here, the most seasoned investors, some of them are saying that our stocks have been in bubble-like territory, but we couldn't disagree more. So I guess the important gist of this article is her investments will at least quadruple in 5 years, and she's disputing the fact that they're in a bubble. Although it's been a hard year for her. Her funds, her ETFs,
Mhm.
ARK Innovations have been going reverse trend compared to the benchmark S&P 500, which we're going to take a closer look into in the next few. So here's information from CoreLogic. They're saying that homeowner equity in the third quarter. This is the money that investors own in their houses, has risen 31% nationwide, bringing it up to $3.2 trillion. So they're kind of like a humongous number, but this article presents it better. It's from MarketWatch. They published this yesterday, entitled "U.S. Household Net Worth Increases in the sixth straight quarter." Fed data show. So total U.S. household net worth rose 2.4 trillion to 144.7 trillion in the third quarter. It means that the value of real estate is actually increasing. As a result, people who own homes definitely reflect the higher net equity in their homes. So the big picture here is economists are wondering how much money Americans salted away during the pandemic. Savings rate has fallen back to earth, just above 7% in the latest data through October, after spiking 30% during the pandemic. The US economy is going to slow next year as government pandemic assistance fades away. Many economists are counting on Americans having enough savings to continue spending to pick up the slack. So I guess it kind of like makes sense somehow. US equity, home equity is kind of like supporting financially for those people who own homes. instead of just relying on their savings.
Well, the recent increase in home prices is already reflecting in my property taxes.
Oh,
So,
property taxes, yeah.
um, but there's a lot of advantages if you're like in the metro area.
Mhm.
There's like some people that are renting their extra space for parking, or
Right.
letting people, park, long term or short term there,
Mhm.
especially if you're close to a stadium. There's some advantages of having extra space,
Right.
for that type of hustle.
Right.
uh, and a
Yeah.
lot of people are doing like rentals, Airbnb,
Mhm.
Verbo,
Right.
if they have a home near a tourist area, and again, or a city where business happens.
Right. The lockdown kind of really brought this up for sure, like expedited its being absorbed by us like consumers who have houses that are, have spaces to rent. But yeah. So here is another article from Seeking Alpha also saying the same. Household net worth rises to record as home prices climb. Household net worths. Oh, it's being redundant at this point, I guess. So I guess you know, having a home, paying for your own mortgage, gives you some kind of boost at least, instead of
Against
like,
inflation, yeah.
yeah, against inflation, instead of like renting out or paying rents. But as I've shared the previous day, I think Redfin came out with a report, which we're gonna go through in a couple of slides, that house prices now are at record highs. So, which reflects the home equity increase over the past year. So this is news from Apple. So on our previous episode, we talked about Apple trimming their estimates by 10 million units. But this is a week later, exactly a week later, that Wedbush analysts, which are very kind of like have a bullish take on Apple, says that iPhone demand is surpassing supply. So not more than a week later, it says here, demand for Apple iPhone is outstripping the supply by roughly 10 million units around the world. So Apple is actually telling one supplier last week that they're going to trim down 10 million, but the Wedbush analyst is saying that it's going to be a shortage of 10 million units around the world. So which is which? So actually, if you're going to review that, it just makes it like similar. Like there's no new demand or no drop in demand. It's just steady as she
Neutral,
goes. Yeah, neutral.
but
So
it's not. Apple's share price is enjoying this
this bullish take, right?
this bullish take. No matter what Apple does, Apple goes up.
Right. So that's interesting. I would say it's still on the safe side, and not be very optimistic by this report by this analyst. Definitely he's been bullish, Danny Ives, but he's a well-known analyst, so we'll see. So this is in terms of our log jam, just an update. This has been a week old. So US ship log jam stretching far into Pacific is longer than ever. Average ship wait time has risen to almost 3 weeks. So this is in terms of our logistics and log jams, or not log jams, but you know, delivery capabilities, which is directly affecting the inflation as a result. Container ships wait almost 21 days on average to enter the port of LA, the highest since the start of the year, looks like. Not a good sign for inflation, because we're going to be receiving the data from the government a few hours from now today in terms of inflation, which is also being taken a closer look at. But yeah, just going back to the recent interview of those financial experts, they're actually hoping for inflation, because for those who have already invested or asset owners, it's a good sign somehow that inflation will be inflating our way from debt, which currently US is around 125%, highest ever in history in terms of debt history, I guess. Okay. This is the Redfin information that we have talked about briefly a little bit ago. Housing market update: prices hit record high as supply hits record low. So supply at low, prices at all-time high. Median home sale price, so median meaning at least 50%, are now selling around $360,000 and $250 a house, up 14% year over year since last year. And this is up 30% from 2019. Just by buying a house back in 2019 would have gained you 30% at this time. Wow. So that's a pretty good jump. As you can see in this chart, we have definitely our ways from a couple of years ago and at least a year ago during the lockdown. And
Well,
new listings. Oh, go ahead.
that's interesting to see, because some young investors, they look at housing as not a good investment. But with the surge in prices, that might change their minds.
Right. Oh, and that reminds me of the chart that we shared last week, that the appetite in buying large ticket prices, such as house or cars, are now at their lowest since the 80s. So it's quite interesting because that kind of like drives consumer demand, which is like what that lady also pointed out. Kathy Wood said that we haven't seen this kind of like consumer Michigan sentiment at their lowest since the start of the pandemic. So consumer comprises at least 70% or 2/3 of the U.S. economy. So if that slows down, that's one thing to watch out for. Despite the agreement that inflation is overall good for the economy, if consumers are not buying, not spending money, not making debt, not paying a lot of interest, so that will definitely slow down the stock market as a whole and the U.S. economy as well. So new listings are down 7%. Yeah, it's been record low. But what's the most important thing that I usually look into this Redfin update is the home buyer demand index. So right now it's still up 15% year over year. So we're still at strong demand in terms of housing, despite the sentiment that people are not wanting to buy homes at this time. Demand is still up there. So it says here, because CPI, it just released just now, consumer CPI rose 6.8% year over year in November. Wow, fastest annual pace since 1982. So yep, definitely inflation is spiking up there. We'll see how the stock market reacts. Biggest annual gain since 1982. So market is still closed at this time. We have a few more hours, at least an hour away from market open. All right. So we're going to skip that. Now we're going to go on to our sentiments and flows. This is the weekly part of our episode that we discuss what's going on with the markets. So in terms of sentiments, according to American Association of Individual Investors, looks like investors have slightly turned bullish from 26.7% last week, 26.7 up now to 29.7, almost 30%. Still low from a historical average of 38%. And bearish investors have now died down, at least from 42% last week. They're at 30.5%, which matches the historical average. So we're at about neutral in terms of bearish right now. Volatility have, of course, died down. It has dropped nearly 21% for the past 5 days, as the stock market has found some relief, some recovery, but it's still up 11% for the past month. And if you're going to look into it on a yearly basis, looks like it's now slightly elevated, trading between 20 and 30 points since the start of this month. Fear and greed index, we're at fear for the stock market, 33, compared to last week's extreme fear at 25. Fear and greed over time. So we're slowly bouncing back up to neutral levels from extreme fear last week. We're gonna see though as the stock market digests the CPI number. Bitcoin, cryptocurrency, we're still at extreme fear compared to last week's fear. So it even went negative, more negative. And the put call options, put call markets, people are buying more puts. It looks like it means that they're thinking that the market might go down. So puts are like kind of like protection from the downside. So for the past week, we're looking at, it's good. It's a comeback, looks like. If you look here, utilities, almost each and every sector of the markets are up at least 1%, 1 percentage points. Technology barely getting there at 0.84%. Consumer cyclical down, still negative at 0.36. For the past month, it hasn't been a fun month. Almost every industry is down except for utilities. But if you're going to look at a long-term basis, year to date, each and every segment is still positive. All right, we're going to look at the two flows, flow of the money, according to Bank of America. So it looks like people are buying more into tech. Wow. Tech saw the biggest inflows. Industrial had the biggest outflows in the past week from November 29 to December 3. So people are buying more tech. People are buying more ETFs, buying some financials here and there, which is interesting. Corporates were biggest buyers according to this Bank of America survey. So looks like, wow, yeah, this is in terms of corporates buying back their own shares. They've been very active during the recent dip. Oh, this reminds me. Oh, I think, wow, you're in mute. Oh, can't hear. So we're experiencing some audio difficulties at this time, but yeah, corporates.
You hear me now?
Oh yes, now I can hear you better.
Okay. Sorry about that. Well, looks like things are normalizing, as you can see. Financials, all pre-pandemic sectors are going back to normal.
Mm-hmm. And it looks like buybacks now, while we are the ones that's also corporate activity, corporations buying their own shares are increasing.
Yeah.
This brings into mind, would this be kind of like some sort of dilution though? Because just last week we just saw the big tech, the leaders of Google, Tesla, Amazon have been actively selling. So would it be, because these are big corporates that are buying their own stock, so would they be trying to neutralize the selling by their leaders to kind of pad what's going on underneath? So we'll see. But overall, I think companies now publicly listed have a lot of cash on hand, and if they don't know what to do about it, they probably should do something that will please their shareholders. So buying back their shares won't be a detriment. Shareholders like that. So yeah, it's interesting to see these kind of like intermediaries that's happening during the course of just 1 week. So yeah, we're going on to the next slide. This is December 3 during the sell-off. So we're back from it. So after the sell-off, we saw the best day for global stocks in more than a year. So this just happened this week after the sell-off last week. So we haven't seen this spike as performance for overall like global stocks. So last week when the Omicron variant struck the market, stock market indices were falling. But not so long after that, as companies, pharmaceutical companies, vaccines, and those manufacturers, drug manufacturers came out with their positive report. Well, initially Moderna was actually saying that, right, that it might not work as well, but he kind of like retreated from that and said that it will work. And then Pfizer came out with a very solid announcement that with a booster, it definitely weakens the variant. So market received that as a positive sign and bounced back up. So this is another article from Reuters, which was published a couple days ago. Hedge funds November performance worse since March 2020. So November, as we already know by now, is we experienced quite a dip in the stock market. So hedge funds actually underperform and during that month, their worst performance in 20 months. So even though Peter Lynch is advocating for active fund managers that can outperform the market, it's not always, green in terms of smart money leading the way, because they do underperform as well. Even though in broadly, retail investors are much more suffering with their picks because of their, underperformance of certain meme stocks or certain stocks that are well owned by mom and pop compared to what's being invested in or the hedge fund picks over the long term. So let's see here. It says on this chart, US retail investors rush to buy Omicron triggered dip. So it's still buy the dip. That mood hasn't changed. So we just saw the largest retail flows on record during last week from retail mom and pops. So did you buy any stocks last week during the dip, Huawei, or you staying on the sideline?
The only thing I was staying in the sideline there for a while, and then I bought, I think, I bought ACC. And I forgot other stocks that I bought. I bought a few stocks.
Right.
I bought some financial stocks.
Oh, okay. Some reopening plays.
Yes.
Definitely a good way to balance out if the Fed will rate hike soon. So
financials and real estate investment trust.
Right. A good counter hedge to inflation. So you see the spikes here. Retail investors are really buying the dip. The Delta dip, you saw the spike. Omicron dip, you see two spikes. So equity exposure, stock investment exposure is now definitely in all-time highs. So according to this Financial Times article, investors buy the dip in US stocks as Omicron drives market volatility, which kind of justifies the chart earlier that we saw. So this is a chart. We're almost done. For those listeners who are still with us, if you have any questions, send us questions in our messenger group or in our email, markyuwawishow@gmail.com. That way we could answer your questions, or at least look for answers and evidences for it. So this is before we end, this is a chart that I want to show to our subscribers. It's National Financial Conditions Index. So this is a chart that provides a comprehensive weekly update on U.S. financial conditions in money markets, debt and equity, and traditional shadow banking systems. So looking at the chart, we're going to see if the chart increases, it means that the financial conditions is tightening. So this happens during recession or slowdown. So looking at it at a broader basis, we're still hovering at really low levels. If you're going to look into it 1 year information, look at that. Well, it's looked like it's the highest it has been for the past year. It's still negative.
Wow.
It's still a little bit easing, but we're up there right now. We haven't seen this high since November of last year. So financial conditions are slowly tightening, even though the Fed hasn't raised its hike yet. I mean, it's the reverse. Even though the Fed hasn't hiked its rates yet. So what more if it starts increasing its rates, which would mean it's going to be a little bit more tighter for the free money, or not free money, but the money flow to the riskier assets. So this is another supplementary. Investors piling into ETFs, oil ETFs. We haven't seen this since inflows are just over. We haven't seen this inflow to oil ETFs since May 2020. So I think lots of big banks, Wall Street banks, are advocating for energy investments over the long term because of underinvestment. So investors have listened and they've been plowing their money into oil ETFs.
And it's going out of Nasdaq. Outflows from Nasdaq have increased. Decreased.
That's what
Increased outflows. Yeah.
that's my suspicion too. But looks like according to Bank of America survey, um, they're buying into tech as well. Tech saw the biggest inflows. So we'll see how it goes.
Yeah. Let's
Money
look at
here,
the
money there.
looking at the 3 month. Well, for the short term, they're going out of the technology stocks.
Right, right. Going out of the speculative stocks more likely, I think, Huawei, right?
Yes.
Because
Yeah.
of the bust and that's happening in the ARK investments. All right. Well, before we end, Huawei, do we have any quote of the week?
No quotes for this week. Just keep saving and keep investing in the stock market, so
Right.
you'll be protected from inflation.
Yes, definitely. I think it's interesting how we should prepare for the next few months now that the Fed is, somewhat decided in terms of starting their tapering. Well, Huawei, thank you so much for coming on this morning.
Thank you, Mark.
Listeners, thank you, sir. That does it for this episode of Mark Yu and Huawei Show. Send us an email at markyuhuaweishow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And Wawi Santos signing out.